timing the market is a very emotional decision for people. You think, am I going to get in today? I was just talking with their financial planning team just before about exactly this. Do I get in today or do I wait for a pullback and get in? And let's say that pullback doesn't happen and instead it goes the other way and the market's 3 or 4% higher. Now you're chasing it. And psychologically, that's really, really hard to do. And I think unless you have a very, very high degree of skill and alongside that, a very, very low emotion level when it comes to investing, then trying to time the market is virtually impossible for you unless you've really been schooled on it. So you're better off being in and getting your money working in it than trying to pin the ding-dong low to get it. It just doesn't work that way. You're better off being in and being out by a few days. And if it's a 20 or 30-year investment that you're looking at, a day or two here or there, it's not going to make any difference at all. Hey guys, welcome to this week's Money and Investing Show. This week we're exploring the perennial debate, property or shares or property and shares. We're going to look at the impacts of interest rates, inflation, the relative merits of both asset classes to help you get the wood sorted from the trees so that you can have a very clear investment strategy moving forward. There's a lot of information to take out of this. I know you're going to get a lot of benefits, so don't just take notes, make sure you take action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitch Olarenshaw.
Good to be here, Mr. B. Thanks for having me. Now, hot topic, and I know a lot of our clients, a lot of our listeners have actually sent this in as a request, as a question as well, is property versus shares. In 2025, where should you be parking your cash?
Oh, that's an interesting one, isn't it? I think, sometimes when you talk to people, it's like property or shares, like oil and water. And I don't believe that. I think it's property and shares as investment classes. They both have very distinct value adds, and they come with a little bit of baggage too, which I'm sure we'll unpack as we get stuck in. So bring it on. And look, it is the perennial question. What do I invest my money in?
Absolutely. And I think, we can talk about our own experiences throughout this as well, because there are pros and cons to each, particularly when it comes down to affordability and accessibility as two major components there. Talk about interest rates, how they affect each asset class, leverage, and pretty much everything in between. But probably our bread and butter, if we can kick off, is in the stock market. So what are we looking at stocks-wise, AB? Performance of the market, how's it all been going?
Look, performance is an interesting one. That's ultimately what it boils down to. And look, we've had some pretty halcyon years over the last couple of years, particularly. If we take 25, 30 years as a slab of time, and I think that's a reasonable benchmark for us to use for this podcast, purely and simply because if you think most people's mortgage is also a 25 or 30 year type time frame, so it gives us a sort of point of reference. Yeah, ballpark, the Australian market's returned around about 9.6% on an annualized basis through that time frame.
So average return each year, right?
On average, about 9.6% if you take that sort of 25, 30 year type window. The US, by contrast, is slightly higher, about 11.5% based on the figures I pulled up. And I suppose we've got to give ourselves a little bit of wiggle room here, because I know there's going to be somebody that's Googling this frantically and going, no, it's not, it's this. And you would think it would be a very, very simple thing to say, how has the market performed? But there are all sorts of questions like, okay, well, for example, with the Australian market, you say it's grown by 9.6% per year. Does that include dividends?
I don't think, I don't know.
So that does not include dividends. It's just the way the index has performed. But if you're going to talk about that and add a dividend into the performance, when we get on and talk about property, you probably need to add the rent back into the price of the property. Yet people don't do that when they speak about property values. So it's gone from 250 grand to 350 grand, is up by 100,000. They don't include the rent that you received on the way through. So that's an ex-dividend basis, and we'll use that as a sort of, I guess, coverall for the benefit of this interview.
Got you. So Aussie market versus US. So US performs slightly better. It's funny you mentioned that. When you look at the Australian market over the longer time frame, so talking 1900 onwards.
That's before my time.
Before your time, only just. It's about 13% annualized average return, to which 81% of years since 1900 have been positive for the Aussie stock market. So on the surface, if, as an investor who's probably early on in the game, you probably say that's a reasonable investment, right?
Yeah, I mean, it's obviously skewed in the positive. That's why markets typically form new highs as time goes by, because it's a reflection, I think, of the optimism of society. If you're a more optimistic person, you tend to be more positive, and if you're more positive, you invest, and if you invest, things move up.
Gotcha. So US stock market, you say, so excluding dividends here for a moment's time. When we look at the performance of the US stock market the last couple of years, now we've seen a belter few years, and we've seen a huge run out of the tech sector, Nvidia, the growth stocks, and everything in between. As an investor, would you still be looking at that as a choice for your cash, even though we've seen a magnificent run from the Magnificent
Look,
Seven.
I think you have to. I mean, you got to go back to, was it 2022 was the last negative year I think we had out of the US?
Yep, 23, 24 positive.
Yeah, and and it dropped by about 22% that year, which obviously is reasonably painful if that's your asset. Since then, it's been on a stellar run. It's been driven into the large part by the giga caps, really, as you say, the Magnificent Seven. And this, I think, is something that's really quite different from the Australian market. We've got more of an old economy type, stock market whereby banks dominate a fair chunk of what we do, probably let's just say roughly a third.
Third of the banks, that's right.
And then another third would come from our mining sector. So 66% of our market is made up of two sectors, which is very, very concentrated. Whereas, and look, I mean, our resources, they served us very well post the GFC. We piggybacked on the back of China's economic boom, and to an extent that helped us avoid a lot of the pain that the US went through. That said, it is a very, very concentrated market, and where the real growth has been is in technology, which is an area that, yes, we've got some tech stocks, but nothing by comparison to that which we see in the US. And the litmus test, as someone that's been around markets for a long, long time, and you would have covered this in university, is the price earnings ratio, the valuation model.
That's right.
And PEs, historically is sort of 17, 21 times earnings. And when they start to get much above that, you go, it's starting to get expensive. It's not a good investment anymore. And we're looking at technology companies that are trading at 70, 80, 100, 200 times earnings.
Easy.
Which is totally frits the wiring in a valuation model if you use PEs, because they're very, very different businesses. And the litmus test is, do you think technology is going to be a bigger or smaller part of the future than what it is today? And very obviously it's going to be bigger. And what you're doing is buying a slab of that future when you buy those companies. And again, these are companies that aren't dominating a market. They're creating a market which in many instances didn't even exist. You think, say, Netflix and streaming, 15 years ago didn't even exist. And now it's a market that they've created and dominate. And you look at Netflix, I got out of Netflix at about $260, and I thought, I'm killing cats here. It's at $900 a share right now.
Oh gosh, it's run, hasn't it?
And at $260, it was trading at 50, 60 times earnings. And this is just so cooked, it can't go anymore.
Yeah.
And this is what the future has the ability to do, is really surprise to the upside. So if you're in the right sort of sectors, the outlook can be very, very strong. Now, of course, there are other factors that can discount that too. Inflation and interest rates are two really important things. And ordinarily, when you talk about interest rates, your focus is on property because there's a mortgage. But interest rates have an effect on the stock market too, in that the cost of borrowing is higher. So companies can't borrow to reinvest in their business, to expand or to build new machinery or R&D or whatever it might be. It becomes, the cost of capital is increased, and it slows that kind of spending down. And it also slows down consumer spending too, because that money is being sucked out of the economy to service higher interest rates through loans and loan repayments and whatnot. Inflation is similar. During times of inflation, there are certain pockets of the stock market that typically do very well, and there are others that don't. So value type businesses typically do better in times of inflation. And you can also typically expect to see a little bit more volatility in the market when inflation is higher too. So there are some distinctions with those big economic headlines as to how they impact on stocks. But to go back to your question, going back on the weave again here, which was, how do you see the market? Are you still bullish? One of the things like I do each birthday for my kids is buy a block of shares. My kids have got a great share portfolio, and we have a lot of kids, so I'm buying blocks of shares quite recently, quite frequently for
every
the year.
month almost. You'd be busy,
almost, yeah. And then add in my wife and I, and so on. So the other day I had to hit the go button. It was my daughter Queenie's birthday, and I'm just about to buy her slab of shares in our family trust. And I'm looking at the market going, gee, this is run pretty hard. And I thought, yep, and it's going to keep running. And bang, hit the go button without thinking about it much more than that. And that really does reflect anecdotally my outlook, because I'm very careful what I do with my kids' money and my family trust money, and it wasn't even a hesitation to hit the go button on that. So to answer your question, do you see it moving up? Yes.
Totally. And I think it's about the long game. So for our listeners out there, time in the market rather than trying to time the market. Timing the market is very challenging, can be done, and we do it day to day here, but we're also professional investors. For the average everyday Australian, just simply buying an index ETF is a really easy way to get exposure to the market. Now, coming back to a topic that you made mention of.
I'll just pull you up on one thing you've just mentioned.
Yes.
You said that we're professionals, so it's a lot easier. And that's so true, because timing the market is a very emotional decision for people. You think, am I going to get in today? I was just talking with their financial planning team just before about exactly this. Do I get in today, or do I wait for a pullback and get in? And let's say that pullback doesn't happen, and instead it goes the other way and the market's 3 or 4% higher. Now you're chasing it. And psychologically, that's really, really hard to do. And I think unless you have a very, very high degree of skill, and alongside that, a very, very low emotion level when it comes to investing, then trying to time the market is virtually impossible for you unless you've really been schooled on it. So you're better off being in and getting your money working in it than trying to pin the ding-dong low to get it. It just doesn't work that way. You're better off being in and being out by a few days. And if it's a 20 or 30-year investment that you're looking at, a day or two here or there, it's not going to make any difference at all.
That's right.
Sorry to cut you off.
No, that's okay. My emotional intelligence was always poor in primary school, but it seems it's worked for my professional life. So there's a win.
Cold, hard trader.
That's right. Now, to a topic you discussed was inflation. Now, if we look at the S&P, we spoke about average annual return being about 11, 12%, right? When you adjust that for inflation, it actually comes down to about 6 or 7%. So inflation, quite clearly to elaborate on this if we can, has a pretty decent impact when you look at net return over time, right?
Massively so. And that's what we like to talk about, real returns. And yeah, if we take, say, 23, I think the average return from the super industry, for example, was 9.6%. And in 2023, inflation in Australia was 6.9%. So on the surface of it, you look at your account, it's grown by 9.6%. You go, that's great. I'm getting ahead, kicking goals here. But on a real basis, stripping out that inflation figure, you've made 2.5% on your money, which is woeful.
Absolutely.
And given the fact that people live longer and so on and so forth, you've got to have your money growing much more than that. And the story's not much different in 24. I think the return from super was about 11 and a bit. Inflation may have eased away a little bit, but it's still a very, very important factor to take into account. And it's a difficult conversation to have with people. To really get them to understand and grasp the impact of inflation. So, if you've got a property and you've done really well, and we'll get onto property, I'm sure, in a few moments' time, you go like, your house is worth $1 million, and you go, that's great. But what does $1 million buy you today in the world? Not just here in Australia, but in the world. And inflation is a killer on that. Everything has got prohibitively expensive, and houses, which we'll talk about shortly, go up during times of inflation typically too. So you do have to factor that in. Your dollar doesn't go as far, so you've got to be outperforming it always.
Totally. And I think, generally speaking as well, if we can cover off, draw cards for the stock market, it's relatively easy to get exposure to.
Yep. It's
also inexpensive. You might be only starting with, $500, a couple of grand, whatever it may be. Yep. You can buy an index ETF very easily. Property, on the other hand, not so much.
That's right. Monday to Friday, 10 till 4, she's open for business, and away you go here in Australia, same in the US. So you can be buying very, very simply with small amounts of money and getting things up and running. And probably the biggest drawback for people investing in the stock market compared to property, and we can, I guess, use that as a segue into property shortly, is that the valuation of your investment you can see on a by minute or by second basis on your screen.
Oof.
And this ability to detach yourself emotionally, I think, is very, very important in the stock market, because if you bought Commonwealth Bank at $160 and it drops to 140, you're down $20 a share. If you bought a property for 1.2 million, you don't know what it's worth. You don't see every day a valuation of it moving up and down. So there isn't a stronger emotional connection to the performance of your investment with stocks and shares, because they're literally mark to market live, and that's something you don't see in property. And this, I think, is where some people struggle, because that emotional connection that a lot of people have to money, you have to work hard for it. There's sacrifices involved. All of those different stories that we can tell ourselves create that umbilical cord tying us there. And so when you start to see that money move up, or worse, down, that can have a really big impact and dent people's enthusiasm for wanting to invest in the stock market, because they find it a little bit more emotional. It's actually very easy. The cost of transactions are so thin, and the amount of money you need to get in there is very low. You can gear up as your experience increases. You can make money in a rising or falling market. You can invest for income. You can invest for growth. You can invest for both if that's what you want to do, and just about everything else in between. So you probably guess that I love the stock market, which is why I've had a 34-year career now around markets.
Absolutely. I'm nearly a decade in myself, so I totally feel it.
Is that a grey hair I see on the side there?
Yeah, I'm losing it. Grey hair. Starting to look like you. It's an interesting one. The stock market, as you say, it can be tough psychologically to deal with. I think if you're playing the long game, stick it in. Don't look at it.
That's right. Time in the market.
Time in the market. Don't look at it. You don't need to open your account every day, once a week, even once a month, but depending on your time frame, obviously. Yep. Biggest thing you mentioned, though, was cost. And the first thing that sprung to my mind versus property, which is a great segue, is the cost of doing business very minimal versus something like stamp duty on property. Yeah. Now, stamp duty is a killer. We've both paid a fair bit of stamp duty in our time. Let's talk about property in regards to its performance, AB. So I think, roughly about 32, 33 years ago, the median house price in Australia was just 110,000. It's now 985,000 in Sydney. Crazy.
It's been a stellar run. I mean, I moved to Australia in 1999. The Sydney Olympics in 2000 was a watershed moment, I think, for our great country, where we were really front and center on the world stage, and it's where we came alive, and our property market really had the touch paper lit during that time for sure. I had to look at some numbers and I had to look at, and again, it's one of those things, depending on what source and what type of dwelling and whether it's urban or rural or whatever it might be. Ballpark, according to CoreLogic, 25-year return on property is about 6.8% per year annualized. That's obviously a capital move, and it doesn't factor in the income or the rent side of things if it's an investment property. And so when you look at the two on the surface, they really are quite different. And performance within that market, just like in the stock market, you look at the performance of the Magnificent Seven versus the performance of, say, some small caps or industrials or utilities or whatever it might be. There are segments within the property market based on regions, location, and the nature of the property too, that are variables that sit with there. And obviously, Sydney would be the crowning glory in terms of, the affordability is insanely expensive city to be in. That said, there are regional areas. I live in Byron Bay, which has been one of the stellar outperformers, particularly since COVID or through that time frame, for performance as well. And so, the location can really mix up the variables that sit within there. If we talk about Melbourne as an example, that's where we're starting to see some of the heat come out of the market. And look, I don't profess to be a property guru. I am invested in the property market, and I always have been, and I will always be, because it is a terrific real asset to hold, not just in terms of somewhere to live, but it's a great investment vehicle too. In Melbourne, we're starting to see some factors change there, including the tax situation on properties, which are starting to discourage investors, which then starts to create a little bit more supply, which softens pricing. So there are regional discrepancies. The nature of a dwelling. So is it a standalone single dwelling, a house, or is it an apartment? And again, if you look at the pandemic, that really changed things significantly, because that pushed the work from home agenda really front and center into the economy. And if you're a professional couple and you've got your one bedder with a brilliant location in the CBD, which was great when you used to walk to work and not have to use public transport and get your coffee en route, fantastic. When there are two of you trying to work from home, it starts to become a real problem.
Oh, yeah.
And notwithstanding the fact that now you're not going to the office anyway, you don't need that proximity to being in the city. The dry cleaners closed down, half the cafes aren't there anymore, and the gym is just shut down because no one goes there. Suddenly the amenities dry up on that too. And what we saw was a big shift into a single dwelling house, where there was more of a desire in the market for people to have more space. A couple of bedrooms or a proper office and then a bed, so you could sort of separate out and work, and also bearing in mind you're there all day when it was the pandemic, have more space to enjoy yourself.
What's crazy is that according to CoreLogic, by 2043, they're expecting the median house price to sit at about 2.9 million in Australia. Fantastic for us. We're in the market, happy days. But for listeners who aren't yet in the market, how do you conjure up enough to get in, because it's just so damn expensive?
It is, and the challenge is the longer you leave it, the more expensive it's going to be.
Yeah.
And I remember this. I don't know, we've talked about this in previous podcasts. I know you've got started on your investing journey at a great age, as I did, as my wife did, as my parents did, as your parents did. You have to get started, and it's so easy to wait and look for the opportunity to get in down the line. The only problem is it drifts further away from you, and your buying capacity, especially if you've got inflation, property's moving up, the dollar's worth less in terms of what you can buy, you're getting left further and further behind. So that deposit you may have had for a two-bedroom unit now buys you one. different quality of life, different product, different yield if you want to invest it. Everything is quite different. So you've got to get there as quickly as you can. Trying to accumulate the money for a deposit is hard work, and it's that baptism of fire that we see all the time. And we've talked to this previously. The bank of mum and dad have been lending their kids or giving their kids a gift to get them in the property market, but being able to save that deposit, hard as it is, and I appreciate I won't win any friends when I say this, it is hard, but it shows that you've got the discipline to be a saver, and you're going to need to have the discipline to have a mortgage to repay as well. So it's a big step for people, and it's like a proof that you can get there. The challenge, of course, is the amount of deposit that's required. And as you snuck in before in the conversation, it's not just the deposit, it's also the stamp duty now, which is absolutely brutal for people.
And lawyers and furniture and conveyancing.
Yeah.
You add your costs in, and based on the median house price at nearly $1 million, you're looking at almost 50 to 60,000 in fees and maybe a basic furniture package. It doesn't really get you a lot. The thing is, you need somewhere to live. I had really good advice from an old mentor of mine a few years ago, and his advice was pretty straightforward. As soon as you can afford it, buy one.
Yep.
That's it.
And it doesn't matter if it's not where you want to be. You have to just be in the market, because the rising tide lifts all ships.
That's right.
And if we're talking about Sydney, you might want to live in the eastern suburbs, and if you've waited, you're not going to get in there. If you'd have taken the money and bought, let's just say for argument's sake, somewhere that's closer into the city, like Redfern or something like that, well, that's not where I want to live necessarily. No, but you're in that market, and as it moves up, you've got the ability to then trade in that market because you've got to start and you've been able to build some equity.
Totally.
So it is crucially important to get in. Stamp duty is also a challenging one because it's different in different states. South Australia, I think, leads the way with the highest level of stamp duty. But as I mentioned just previously, Victoria, there are a slough of new taxes, particularly for landlords, that are kicking in there. I saw one the other day. If you live in the inner city and you've got off-street parking, you now pay a congestion tax.
It feels like it's London almost with the congestion tax. Crazy. It's funny, the favorite stat I always like to bring up anytime we talk about property. In 1970, an average person purchased a house about 4 times their annual salary on average. Now it's about 14 times their annual salary. Now, I don't know too many people that are purchasing houses for 14 times their salary, to be honest. I think, as you say...
I'm just thinking about what sort of house you'd be buying if it was 14 times your salary.
Yeah, and I'm not being paid enough, am I?
Stuff. You'd be having music videos shot there, I'm sure.
Oh, yeah, thanks. I think, as you say, it comes a lot down to how a lot of first home buyers are actually getting into the market, because very tough to save up a 20% deposit for something that's 14 times your annual wage. It doesn't make sense mathematically.
20% is for an investment property. So if it's a primary place of residence, I think 5 is where the banks go at the moment. They'll be right. But you need to have their mortgage insurance to go alongside. So you've got to pay somewhere along the line. And I think what it does, we've talked about this previously in this podcast again about the structural imbalances within the property market. We've got supply issues. We've got population growth without having that going on. I just saw, I think on the Gold Coast, there are 40,000 apartments have been approved that haven't been built, and they're never getting built. Let's face it, it's not going to happen. So, there are those structural problems within the market. So interest rates and inflation, how do they impact on it? We talked a little bit about the stock market and how that can work. So during times of inflation, that's typically great for property prices. Why? Inflation is effectively, what is inflation? Inflation is more money that's in an economy chasing a finite amount of resources in its simplest form. It's not costs going up. That's the byproduct of inflation, and it's really important to understand the difference there. So we've gone through a period of time, particularly since the pandemic, as many of the Western countries have, where there's vast amounts of money that was injected into the economy, whether that's through JobKeeper, JobSeeker, Job Today, or any other scheme that the government can invent to throw money into the economy. And the net consequence of that is you've had all of this extra cash chasing a largely fixed amount of resources, including property. So that's why we've seen inflation kick up, and inflation has been one of the reasons, the side effect anyway, has been where we've seen property prices move up, because property typically is an inflation hedge. It's a real asset.
Benefits, though, of property, when you think about it, you're able to only put down a 5% deposit and have the other 95% bankrolled from a financer. So to get started, you can utilize the element of leverage. And then if there is a return on your investment, you've got a leveraged return, right? Which is a very attractive draw card for a lot of people.
It certainly can be. Obviously, if you've inflation, you've also typically got higher interest rates too, which means that debt servicing becomes, prohibitively expensive for many people. And so one of the things, and we talk about this actually in the book, is a formula for working out if you're able to borrow X, actually borrow less than X. And that gives you that degree of comfort. If rates move another 1 or 2 or 2.5%, you've got the ability to not be having the rivets pop off. Now, that's a very difficult conversation to have when there's an outright affordability issue and you're saying, not only is it expensive, and you're saying, you don't even borrow all the money that you could to get there. And that's just for your long-term financial security, because the percentage of people's income that's being spent on housing, whether that be rent or whether it be through a mortgage, is running at all-time highs. And there is a trade-off on there in terms of your ability to service other things starts to drop away. You've got less money for stuff, so maybe you don't eat as well. You find cheaper ways of eating, which may be a good thing for you. It may not be too if it's less healthy. You may have more financial stress when that mortgage payment gets drawn out of your bank account each month, which is not great for your emotional well-being. So there is a consequence to that repayment level, whether it rent or mortgage repayment, that needs to be taken into account for people's well-being. The other thing on there with inflation is that, bear in mind, if you've got $1 million of mortgage to pay off, and let's say you're able to service your debt levels as they stand, if you've got inflation, that $1 million in 20 years' time is worth a fraction of what it is today. So inflation is actually a great thing if you owe money. It's just you've got to have the cash flow to be able to support that, which is where, if it's a primary place of residence, that's punishing because it's you that has to pay the mortgage. But if it's an investment property that you have and you're able to raise your rent to support the repayment of at least the interest component of it, in 20 years' time, when you've got to go and pay the capital down and that property's gone from being worth $1 million and it's now worth $3 million, well, that's not a bad outcome for you.
Happy days.
This is the incentive to get in the market. And I know if someone's a renter, they'll be saying, you capitalists, it's all your fault. It's not our fault. Talk to your MP, get them to build more houses. It's just a dynamic that's in the market.
Totally. And I think as we come to the conclusion of our broadcast, AB, we talk about property versus shares. The message is quite clear, though, which we mentioned at the start, and that's both are a viable investment option.
You have to have somewhere to live. So you need to own somewhere, and it's the foundation of any wealth strategy is to own your own home. You have to have that foot in the game and moving along, because you've got an asset, somewhere that you're going to live. And I hate talking about your home as an asset. It effectively is. And it's also one of the very few tax-free assets that you can have. It's capital gains tax-free. It's a primary place of residence. And let's hope that stays to be the case, because it's a terrific incentive for people to own their own home. Once you've got that base, it can then open the door, if you wanted to be more aggressive, to better borrow more, because you can use it as security if you want to do that, to get into an investment property. But it all comes down to that foundation. How do you get the deposit to buy your house? Well, you need to get your money working harder than sitting in the bank. And this is where I think the sort of the left and right combination of stock market and property work together. The stock market, when you do it correctly, can be a terrific way of creating wealth, and the property market can be a terrific place to store it. And if you use this stock market trading, investing strategies like cash on demand as a way of accumulating funds to buy another property, sounds familiar because that's your pathway, then you're in a situation whereby you've got an asset creation vehicle and then you've got an asset store vehicle, and they are really different. Property is a long-term investment. It has to be for many reasons. One is the cost of transaction. You can't be in and out. It's going to kill you in terms of fees. Shares you can be in and out of very, very easily. Secondly, the ability to generate very, very quick income in the stock market is very much there. Once you've created that income, parlaying it into another, maybe slower moving asset. And I say slower moving just based on the percentages, 6.8% over the last 25 years, according to CoreLogic, versus 9.6% from the stock market in Australia, or 11.5%-ish in the US. They are faster moving vehicles, but they're more volatile. So smoothing that volatility out by getting the cash flow from there and stuffing it into your primary place of residence and or an investment property and everything that goes behind there is, I think, a marriage that's made in heaven. And yet so many people are just one-eyed. Oh, I'm a property guy, I don't touch a stock market, or I'm a stocks guy, I don't touch. You have to look at both, because when they're used correctly, they're a very, very well-balanced investment strategy.
Barbecue or tomato sauce, I'll take both. Thank you very much, AB.
Love it. Catch you later. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.